Hello, and welcome to the East Africa Business Podcast. This show is all about showcasing entrepreneurs who are building businesses in this exciting part of the world. From reading high-level articles about the region, it can be difficult to really understand what's going on, and so my hope is that these interviews somewhat bring it to life, as well as stoking your curiosity to go find out more. On that, do take a look in the archive for more episodes that we've done, but for now, let's enjoy the rest of this funky intro music and then get started with the show. It's widely acknowledged that one of the biggest prohibitors to the development of East Africa is lack of capital. The global economy is premised on aggregating savings in, say, pension funds, and then deploying it to areas where it will earn a return. This investment is what generates economic activity, stimulating business growth and creating jobs. It also generates a return for those running, say, the pension fund to disperse to their members. Now, traditionally, this large-scale movement of money has happened only in developed markets. Developed markets are structured in a way that allows finance professionals to calculate the riskiness of an investment and therefore feel comfortable parting with their capital with an expectation it will be paid back. Traditionally, the methodology for deciding whether to invest big pools of money in Africa has been done using the same framework as it has been for developed markets. This hasn't boded well. In short, the techniques for deciding how much money to invest have meant that only small amounts can be safely deployed. Lendable have taken a different approach. They are a technology-enabled debt platform created to help non-banking lenders scale. They use in-house software tools and algorithms to analyze loans and offer facilities that make sense for lenders based on their loan books. It might sound simple, but this approach of buying a loan book rather than looking at the assets that a company has is a paradigm shift towards creditworthiness and has meant the company has been able to unlock millions of dollars of capital that, using all the old frameworks, wouldn't have been deployed. Now, I appreciate that all might have sounded a bit technical and a bit advanced, but Daniel, Lendable's CEO, and I go into the details of how this works, the impact it has, as well as the tales they've had along the way of running their business through 2 Kenyan elections, and also what it takes to attract US hedge funds to invest in Africa. This is, for me at least, a great episode around how large-scale impact can be achieved through facilitating the transfer of wealth from the developed to the developing world. I hope you enjoy. Cool, so we're here today with Daniel from Lendable. Daniel, welcome to the show.
Thank you.
So to get us started, can you tell us a bit about you and a bit about Lendable?
Absolutely. So Lendable started in actually San Francisco, California. At the time I was working in venture capital, so my career before that had been all in clean energy in the US, starting out on the policy side, working in DC, and switching over to the venture capital side in San Francisco. And a lot of what I was doing was investing in not necessarily the underlying technology companies, but the distribution and finance companies for clean energy. So answering the types of questions of how do you finance solar for residential at scale? How do you finance efficiency gains for commercial buildings? And so we thought a lot about these questions of deployment. And I was lucky enough that in my day job, a bunch of non-US companies started applying for capital. And through that lens, I got to learn about really primarily 3 geographies, East Africa, Mexico, and India, through the lens of solar finance. Unfortunately, my investment committee at the time, or fortunately, said no to all 3 deals that I proposed. And I found myself way more excited about those than what I was doing every day. And so I went back to them and said, okay, I understand we can't do deals, but I'm going to leave and go do my own thing. Will you invest in me? And they said yes. So that was really kind of the origin of Lendable and kind of where I come from. My 2 co-founders, one of them is actually my cousin, Dylan, who's our CTO. And at the time, so his background is all in technology. He was one of the first employees at Lyft, which is the second biggest ride-sharing company in America. and had done a lot of distributed systems and data infrastructure work. And so as I was getting ready to leave Greenstart, the venture firm I was at, we started talking about what it would look like to use technology to better understand credit risk in a frontier market context. And that was really kind of the origin of the very beginning. What we quickly realized, or probably a little slower than we should have in about a year, was that it wasn't just a technology problem, it was also a kind of financial infrastructure problem. Venture capital, while it is finance, is kind of the preschool of finance. So I didn't have necessarily the chops that I would have wanted to have started that type of company. So we brought in our third co-founder, a guy named Arjun Batra, who at the time was at BlackRock, the largest asset manager in the world, building out essentially marketplaces and platforms for how BlackRock could transact in new asset classes that had been deemed either too small or too illiquid in the past for the asset manager. And so he had spent a lot of time thinking about how to use technology platforms as a big manager to deploy capital. And so he kind of filled out our triumvirate.
Very cool. So in a sentence, you're in the business of giving money not giving it, financing, giving it on the hope that people pay back.
Yeah, so I mean...
But those people are, you say, distributors. You name mainly fairly sizable businesses that are already operating, is that right?
Yeah, so we're in the business of connecting what we call alternative lenders, so non-banking lending institutions. Those could be a pay-as-you-go solar company, it could be a boda finance company, it could be a microfinance company, it could be a mobile lender. We're in the business of providing them with the capital they need to scale exponentially. And the way we do that is connecting them to capital markets in the US and Europe.
I see. Okay, so you're not actually dealing with the day-to-day repayments from the individual end user. You're one step back from that.
That's exactly right. We are an intermediary. We, from an analysis perspective, what's different about us than I think every other intermediary in this space that I know of is we do get into the weeds. So we've built a whole bunch of technology to allow ourselves to understand the end borrowers. And the reason for that is we finance a little differently than most firms. So most firms or intermediaries would essentially give a loan to an alternative lender. And the alternative lender then on-lends that capital. They take it, they lend it out to their borrowers, but the loan to the alternative lender really has no direct relationship with the end borrower. We actually buy loan portfolios. So we would go to a client and say, you've given 10,000 loans, we'll buy those 10,000 loans from you at a discount, and that'll allow you to go finance your next 15,000 loans through that. And because we buy those loans, we actually take the repayment risk of the end borrower. And so we need to understand that repayment risk.
I see. Okay, so traditionally, the intermediary would give, let's say, the microfinance company, they'd give them a loan of, let's say, repayment of 5%, the 5% rate. The microfinance institute would hope that their repayment would be more than 5%, and then that means they'll be able to pay back. Why have you decided to go this other route?
Yeah, so the traditional model of on-lending, essentially in the US or Europe, which are more developed alternative lending markets, makes up the smallest part of the funding stack. And the reason for that is when you lend to an entity, you're lending to their balance sheet, the corporate entity. And the way that you analyze that corporate entity is typically in looking at debt to equity ratios, collateral and assets, so on and so forth. The challenge of doing that with these types of companies is that their only real asset is their loan book. Typically they don't own any property, they don't own vehicles, so they have no hard assets. And their equity base is typically relatively small compared to their revenues. And so the challenge in looking at a company like that from a pure debt perspective is then you can only give them a very little bit of money because their equity is small and their collateral is small. And so the reason to look at the portfolio as a standalone is twofold. One is it allows you to exponentially scale the capital you can put into that market, because what you're saying is, I don't care about the corporate entity's debt to equity ratio. I care about the quality of the portfolio that's being created and the scale of that portfolio. And number two is, we believe that these portfolios are actually high quality and understandable repayment streams. And what that means is we want to have a direct relationship or ownership over those. And so we want to actually take the repayments from the end borrower, and we believe that's a safer financing for us than relying on the finance department to scrounge up however much is the next loan repayment tranche. So that's the way that we think about it. And again, if you go to a US, European, or Chinese context, which are very developed alternative lending contexts, the vast majority of financings are in off-balance sheet SPVs and securitizations, which are variants of what I'm talking about.
Interesting. So you've got basically got Lendable, you've got the loan giving. And so what do you call it?
Alternative lender.
The alternative lender, and then the end borrower. Can you talk me through sort of the process of how you understand, right, this is a good deal, this is not a good deal?
Yeah, totally. So when looking at an end borrower, a lot of times we hear a developed market kind of framework applied to frontier markets, which is just wrong, which is there are good borrowers and there are bad borrowers. In an environment where regulatory and should I start again? Okay. In an environment where the regulatory guidelines are very clear and collections are homogeneous in the market, then you can actually distinguish between good and bad borrowers because they all have the exact same incentives. So just to give you a really simple example, if you give a loan to two people in the US or in the UK, the rules of that loan are going to be, let's say it's an auto loan, are going to be basically identical. And if they don't pay, basically an identical thing will happen to them. When you go into a frontier market, that's just not the case. If I get a loan from one company versus another, there's going to be very different follow-up procedures. Some will report to the CRB, some will report to the kind of central database.
Are you talking about differences between country or differences within the country?
Within the country. So if you just look within Kenya, for instance, one pay-as-you-go provider might, pay-as-you-go solar provider might report bad customers to the CRB. Another one, the credit bureau, yeah.
And that's basically, what are the implications of being listed?
Yeah, so if you're listed as a non-payer at the CRB and you try to get a bank loan, they'll check the CRB and know that you...
So CRB is like the public...
Yeah,
and so
it's like Experian or FICO in the US. So it's a credit score.
Okay.
Essentially is where it will go. Right now it's a credit database. So I can look up anyone's name in Kenya. Most people won't come up in it because it's relatively new, but some people will, and it will say they did not pay back a loan. And so some companies that give loans will report bad payers, some will not. And that's a different incentive for the borrower, right? And so the analysis we're doing is not, is this person a good or bad borrower? It's, for this given product, is this person have a high likelihood to repay or not? And it's a very different predictive question to be asking. And so when we look at portfolios, essentially what we're modeling is really two things. One is we're modeling the individual behavior of how someone relates to that given product. So if I am let's say a 24-year-old boda driver in Nairobi.
That's motorbike.
Yeah, motorbike taxi. If I'm a 24-year-old boda driver, so I'm a professional taxi cab driver, getting a loan for my bike, versus I am a farmer in Machakos County who's getting a solar system that's 50 years old, I'm going to have a different personal relationship to that asset and my likelihood to repay for that asset. And that's kind of a credit score. On top of that, the analysis we have to do, and this is the really hard mathematical stuff, is correlation analysis. And the reason this is so important is, just to give Uganda as an example, a country we do business in Uganda, 80% of people are subsistence farmers. And so whether I say I'm a teacher or a boda driver, I'm still getting my food from my garden. And so if I don't get rain in a season, the teacher and the farmer are going to have more trouble repaying. That might not be true of Nairobi, where very few people farm. And so understanding the correlation of individuals is equally as important, because you could have a whole bunch of really good payers and a really bad rainy season in Uganda, and you're going to have a whole bunch of bad payers at the end of the season. So you have to both understand uncorrelated risk and correlated risk. And we built a bunch of predictive algorithms which basically look at geography, characteristics of the individual, past repayment on a given loan, and the product type. And from those characteristics, we are highly accurate at predicting the aggregate repayments of a portfolio. Meaning if I have 10,000 borrowers, how much will they pay month on month over the next 18 months? And the reason that's so important is that's how we set the discount rate, or what you'd call the loan to value ratio in finance, of how much money we're going to give for a given portfolio.
And what's obviously each one's different. Are you roughly paying 80% of the loan book value, or what's the...
Huge variation. Okay. Huge.
What determines the variation, and what's the rough range?
Yeah, so the determinants for the variation are quality of portfolio first and foremost. So
Lendable comes in and you say, okay, this looks like a bad loan book, or this looks like a good loan book.
Yeah.
I'm interested, what's the... surely it's in your incentive, it's in your interest to imply that it's a bad loan book, because then you can say, well, we're not going to pay as much for this.
Well, it is and it's not. So the reason it is what you just said, which is you have more essentially collateral ratio if you do that. So you have more protection in the investment. But the reason it's not in our best interest is because we're trying to move as much money as we can. We only make money when we move money. If we set our loan to value ratio higher, we actually move more money per deal. And so we actually have both sides of the incentive, which is exactly what you want to have, right? You want to have a tension between risk and return as an intermediary. And I mean, the important thing to know is the capital that we invest, some of it is our capital. So it's Lendable Inc.'s capital. Some of it is third-party capital, and the majority actually is. So we actually are an investment advisor to investors on behalf of whom we manage an SPV. And so we're making
SPV,
a special purpose vehicle,
which is
essentially a fund.
Okay.
It's not a fund in structure or from a regulatory perspective, but the way that it functions is there's a pot of money and it gets invested.
Okay, so they give you a pot of money and say, go and bring up more.
Exactly. Yeah. So we have both a fiduciary responsibility to our investors to make sure we not only make good decisions on behalf of their principal, return the capital they gave us, but also to make them money. Simultaneously, we're putting our money where our mouth is, so we have a strong incentive to not lose our own money. And so, to your point, we really don't have a strong incentive either way. We kind of have an incentive both ways, which balance each other out. The range of advance rates, which are predominantly predicated on the quality of the portfolio, number one. Number two is really foreign exchange movements. So the collateral of the transaction is also used to pay back a USD loan. So if it's the companies in Kenya, they're getting paid in Kenyan shillings. So there's some level of mismatch there, which needs to be accounted for. But that range can range from, on the low side, if a portfolio has lower repayments, something like 45% loan to value ratio, and that can get all the way up to 85% loan to value ratio if there's high quality.
I see. And the customers you have, what have they said is why do they use Lendable? Is it because this is a good way for us to get cash, or are there other elements to it which they find?
Yeah, so we exist in an incredibly cash-constrained environment in East Africa. So you talk to any CEO of any finance business, and the first thing they will say to you is, I can't get enough money to grow my business. And so that's the context in which we exist. And we are typically the largest debt investor for most of our partners, and are willing to give them 3-4 times the amount that a local bank or the local private markets individuals would give them. And the reason is because we're confident in our ability to assess the portfolio, which is what we're lending against. But that's not the only, I think, reason that our partners so far have been happy with us. Although the primary reason is we give them more money than other people will give them. We also provide a lot of analytics to our partners. And the reason is, to get back to incentives, we want our portfolios to perform. And so it's in our best interest to provide analytic capabilities to our alternative lenders so that they're better at credit provisioning and collections. And so we do everything from providing kind of productized tools. So we have kind of a business intelligence dashboard that we provide our alternative lenders. And we have something we call the follow-up score, which is essentially an automated score of all their customers to tell them who is the most likely to stop paying and who is the most likely to keep paying, so they know who to follow up with proactively. But we also end up providing at times kind of one-off consulting work when we have capacity, which for a lot of these companies is a huge benefit because we have 3 data scientists on staff, and data scientists are incredibly expensive and hard to find and hard to manage. And so for a lot of our companies, there's no way they could ever afford a master's or PhD student in mathematics or in Bayesian economics, for instance. And so we can provide them with some of that capacity that on their own they'd never be able to afford as well.
That's interesting. So it's partly it's around here's the cash, but it's also about here are the tools for you to run a better business.
Yeah, I mean we're perfectly aligned with them because we come in and say we are taking the same risk you're taking. We are taking the risk that your borrowers don't perform. And so we need to really understand your business, but we also really want to lean in and help. Because if you don't succeed, we're in trouble.
Yeah. What have been some of the, so I think you mentioned that the sort of the 3 pillars of how you assess it is the geography, the quality of the borrowers, and the exchange rate.
No, so the ways we assess the repayments are essentially the individual, so whatever we know about them, geography in which they exist and stuff about that. And then the third is how they've paid up till today, because a lot of them already have existing loans with the same lender.
So how's that data being collected? How's the repayment data, the existing repayment data already being collected?
Yeah, so this is the beauty of operating in East Africa and increasingly West Africa is everyone pays over some version of mobile money. So the vast majority of payers. And the reason that's so important is we have verifiable repayments. So we've automated basically the process of taking data out of our alternative lenders' core database, their CRM or their core banking system, whatever it's called for them. And then B, we take data directly from M-Pesa or Airtel Money or Equitel or whatever that payment gateway is. And we're able to automatically verify those 2 payment streams and say these match or they don't match. And so we have a verified payment stream on repayments. In terms of the other data, data like what type of product does the person have, how old are they, so on and so forth, we have to rely on our alternative lenders to collect that data. And so we work with a lot of them to improve their data collections, both policies, but also their technology. So we spend a lot of time helping them with that.
What are some good policies for collecting data?
Start early. You can't go back in time and recreate a data set. And so just starting somewhere is really valuable. I think with a lot of companies we work with, they rely or had relied on data entry versus automating data collection. And the problem with data entry is somebody gets sick or they get lazy and you get a few weeks behind, and then you get entries typed in at the wrong time, so it looks like payments happen later than they really happened. And so you just want to get rid of that up front. And it sounds expensive at the time, which is, I'm going to pay a consultant to integrate M-Pesa with my core banking system, or I'm going to pay to have my bank account automatically reconcile with my accounting system, whatever that integration might be. But the few $1,000s that costs will save significantly more in retrospective data cleaning than you would have had, than you'd have to pay. So start early and automate the process by which you collect your core data. And core data is always repayment data. So everything else you can make mistakes on, but if you don't know exactly how much you're getting repaid from every single one of your customers, you got some trouble.
Understood. Cool. And in terms of, so it seems that you're collecting loads of data, you're looking at these different things. What are some of the surprising insights that you found from doing this business?
I'm trying to remember. It's been so long since I've been in the data, but let me think about a few examples. So the Kenyan elections were obviously longer than any of us expected.
For context, there were 2 elections in Kenya.
Right.
There was one, and they had to redo it again.
Yes. Hence the Kenyan elections last year. No one could have predicted that there would be 2 elections. We did believe that we could predict repayments through the elections, which was somewhat of a controversial and audacious claim to make to our investor base, which is everyone stopped lending in Kenya around the first election, and then once it was clear there was going to be a second one, the lending continued to be frozen. We were advising to continue investing. So we actually invested both a week before the first election and 3 weeks before the second election, which was a very, again, kind of risky, perceived as risky move on our behalf. I think the interesting learnings from that were, to some degree we were right. You can predict repayment rates through a election in Kenya. The reason we were confident in that is because we had observed and trained models based on the Ugandan election the year before. And so we had some level of understanding of what a not so great election could look like, because the Ugandan election was a controversial election where you had people in the streets for a month after the elections, you had telecoms being shut down. And so we'd seen what it looks like to have a bad election, and we were confident that we knew what the worst case scenario would look like based on that. And that proved to be right, but we were right in the aggregate, and we were very wrong in the micro. And where we were wrong was we assumed that all of our asset classes that we lend to would all see a decline in repayments starting 2 weeks before the election, and a continued decline up until about 2 to 3 weeks after, and then a rebound that would occur at 2 to 3 weeks after the election. And we were right for some things and totally wrong for others. And so one of the interesting learnings was, and it makes sense if you think about it, kind of a priori, but the solar loans in our portfolio performed better going into the election. The Boda loans and SME loans performed just as we'd expected. They got worse 2 weeks before and then rebounded 2 weeks later after the election. And so the solar loans we were really confounded by. We kept thinking, this has got to be a mistake. We're seeing the best weeks of performance we've ever seen in solar going into the election. And as we looked closer at the data, we realized it just makes sense. If you were somebody out in Homa Bay in Western Kenya, and you're going into an election where you know there is going to be some level of chaos, what do you want to have during the election? You want to have light, and you want to have radio. You want to know what's going on. And so everybody paid for like a month in advance because they were afraid the telecoms were going to get shut down. And so you saw this huge spike in repayment leading into the elections, as well as sales for a number of different pay-as-you-go providers that we had worked with. And so we thought that was a really interesting learning that makes sense, that people want information and light when things get bad, and therefore certain assets will have high repayment. And this gets back to a way earlier point I made, which is you're not judging the quality of an individual. You're judging how they're going to interact with a certain type of asset or a certain type of loan. So this is not about, a mama in Homa Bay. This is about her relationship to light and radio. And that's what you're trying to predict. In that individual instance, we were wrong. Again, in the macro, luckily we were right, and didn't lose our shirts.
Very good. Okay. When you look at what Lendable might do, Lendable's going for how long? Is that 3-4 years?
About 3.5 years.
3.5 years.
Yeah.
When you sort of project forward the next 6 months or the next 2 years, what's on the horizon?
Yeah, this year for us is all about scale. So we dispersed our first capital in October of 2016. So our first year and a half of operations, we were just an analytics company. For 6 months between the end of that period till October 2016, we were getting ready to transact. As I said, October 2016 was our first transaction. So 2017 was really our first year of dispersing capital, our first full year. And we learned a bunch. Luckily, we didn't learn it at the expense of losses. So last year, we returned about 15% to investors through our facilities and had no losses. So we had a really good repayment year. But we learned a bunch about providing a quality product to alternative lenders. And that's been really the main area of learning, which is what do they need? What are the services and the kind of nuances to those services that we need to get really good at to make sure we're providing that value?
What's the number one service you need to provide?
I mean, it's capital, but the question of how it needs to be provided, I think early on we had an incorrect thesis, which was that standardization of the loan product would lead to lower closing costs and therefore a better product. And there's some rationality to that, which is lower cost is a good thing. But in reality, customization is more important than cost to most of our clients. And so one of the big learnings and hard learnings last year was we have to be more willing to customize for larger transactions. And so that was a big change we made in really Q4 and going into Q1 of this year, was for transactions above an annual value of about $4 million, we are willing to do way more customization than we used to do.
What's an example of some of that customization?
If the underlying loans, so the end borrower loans, are, let's say, 3 months instead of 18 months, that's a very different loan profile and cash flow profile. And our traditional product, what we call our off-balance sheet product, essentially we purchase loans, they pay down, and we give you more money. And for 18-month loans, that makes a lot of sense. But when you start getting into like 60, 90-day loans, the challenge with that is we're buying loans and 40 days later, they've already paid off. So we have to give you more money like every 20 days. And that just creates a lot of operational work. And so for those shorter loan products, a lot of our clients want the ability to recycle capital. So they want to be able to take capital, redeploy it, then pay us. And so we've been developing products for those shorter tenor loans, and there's a whole bunch of different other variations on structure, some small, some large, that clients need. So that was probably the biggest learning from 2017. And so 2018, we finally have a team. We went into 2017 with probably, I don't know the exact number, probably 8, 9 employees.
Now you're at what?
We're at 21, and we'll be at 27 in the next 3 months. So we just didn't have the scale of team that you needed to do lots of transactions at once. Now we do, and a lot of what we're focused on is how do you take a product that we now know works, and how do we scale it across different sectors and across different geographies. And so just to give you a sense of like what that means, in Q1 2018, we've moved essentially as much capital as we moved in all 2017. So in the first 3 months, we moved as much as we did in the 12 months preceding that. So the scale of capital we're moving is much larger. What that means is, number one, we have way more partners, and that's a lot of work. And
partners are the people giving you money?
Yeah, no, alternative lenders. And on the other side, we have to raise way more capital from investors. And so we're out, we used to raise $2-3 million per investor, and now we're looking at $10 to $25 million tickets from investors. And so that's just a really different market.
Is that, did you start off with individuals, or has it always been institutions?
So we started off with family offices.
But why did you choose that?
Family offices are interesting. They're really hard to find. They're very heterogeneous. No two family offices are the same. But once you convince one of them that what you're doing makes sense, they're incredibly flexible, and they have relatively large amounts of capital compared to just individuals. Also, we're a U.S. company. The U.S. has very stringent regulations around retail capital for products like ours. So you have to be very conscious of how you market your product, who it's marketed to, all that kind of stuff. And so we started out with family offices, and that was really end of 2016, beginning of 2017. By mid 2017, and this was a surprise to us, we had almost entirely graduated to hedge funds and alternative credit funds. And so one of the key theses of our company, of Lendable, and mission of our company is, we are trying to bring commercial capital to new asset classes. So we believe that the scale of the credit gap for consumers and SMEs is so large that there's no way impact capital can solve it. There's just no way. You're looking at a multi-trillion-dollar gap in sub-Saharan Africa alone. So the question then becomes, who has multiple trillions of dollars? And if you look at the US and Europe, and you look at asset management of more traditional asset classes, like fixed income, there are multiple trillions of dollars looking for places to go. And so that really is the end game for us, which is, how do you convince markets that normally, if you said, hey, we provide investment opportunities in Kenya, they'd go, where's that? How do we convince those firms to believe that this is a commercial asset class, just like thin file clients in the US, or auto lending in the US, or mortgages in the UK? So that's our end game. That's what we're trying to do.
So, and the crux of it is using your data, you being able to analyze this alternative data which is out there, and use that to predictably project people's repayment. Is that the essence of it?
Yeah, I think there's three parts of what a commercial investor needs that doesn't exist in the market and we're trying to create. Number one is that, which is a detailed and repeatable way to understand the risk of cash flows of the financing. No one in this space has invested in the technology to do that, and it's hard. So that's number one. Number two is just the nuts and bolts financial structures to make this a viable asset class. Most impact funds are not structured in a way that any commercial or most commercial managers would take seriously. And that's for both return reasons. So a lot of impact funds return 5 to 8%. US fund managers in the kind of hedge fund space and alternative credit space have net return targets of 7 to 10. So that counts out the majority of impact funds. Number two is just they want different things, like service providers, fiduciary servicers, cash managers, a whole bunch of different kind of structural elements that they want that they're used to seeing in sophisticated asset-backed investment opportunities like mortgages, like auto loans. And so they want to see something they understand. And so number two is that structure piece. And number three is, over time, it's scale through standardization. What I mean by that is, for a lot of these large asset managers, their first question for us is, if I gave you $25 million, could you deploy it? And the problem for them in a lot of these asset classes is, if they let's say they ignored Lendable and they said, we're just going to go fly to Kenya and we're going to do our own transactions. The problem is, how many $25 million transactions are there in Kenya? 3 a year, 4 a year? Not a lot. And so is it really worth their time to fly a team to Kenya to take a look at 3 possible transactions in the whole market? 2 of them might be bad. The one that might be good might be competitive. You might lose it. So you just spend a bunch of time looking at 4 transactions. And the answer is no, it's not worth the time and energy when you have as many opportunities as you do in the US. So what we can give them is an aggregation of lots of $5 million transactions, $4 million transactions to get above their hurdle rate. And so that allows them to basically look at the kind of sum being greater than their parts, where Lendable is actually the counterparty for them. They look at us and they go, I can deploy $25 million through Lendable. I don't care what receivables you're buying on the other end, as long as it, from a credit perspective, and if they have an impact lend from an impact perspective, makes sense. But fundamentally, I'm going to trust you to go do that for me, and I'm just going to go give you $25 million, and you're going to deploy that on my behalf.
Fantastic. Cool. And people listening at home, how can they? I suppose we've got a number of different big parties. We've got the alternative lenders in East Africa. We've got the investors, etc. How can people learn more about what Lendable are up to?
Good question. If you're in East Africa and you work in the financial sector, we have an office in Nairobi. We're in Kampala every 30 to 45 days. We're spending more time in Kigali. We're now starting to look at expansion into West Africa. So we're regularly in Ghana and Nigeria at the moment. If you just drop a line to us through our website, we have a kind of area where you can fill in information, and we're highly responsive to it. We'll carve out time to come see you in whatever city you're in Sub-Saharan Africa. If you're an investor in the US and Europe, it's kind of same but different. We have a place on our website where you can say you're interested, and our capital markets team in New York will follow up and reach out to you. And then we'll also be, this year, we're going to be at Lend It next week in San Francisco. We'll be at AFSIC, the African Investing Conference in London in May, speaking. And so you can also come find us at conferences.
Cool. And it's lendablemarketplace.com.
Lendablemarketplace.com, yeah, that's right.
And it's there's an annoying company, lendable.co.uk.
Well, they're not annoying. They just happen to have the same name.
That's it. So basically, Lendable Marketplace is more Lendable. And in terms of, you're on Twitter and
yes,
all that sort of stuff?
We're on Twitter at Lendable Inc. We're on LinkedIn, Lendable Marketplace. Yeah.
Great. So we'll link to all those in the show notes as well.
Awesome.
Well, Daniel, thanks so much.
You're welcome.
Before we head, just a quick moment to say thank you for listening. You can see show notes for this episode by heading to www.samfloy.com/podcast. That's samfloy.com/podcast. If you'd like to learn more about the podcast and stay updated on future episodes, as well as a few other things like behind the scenes pictures, then please check out our Facebook page. Search for the East Africa Business Podcast and you can like it from there. Finally, if you felt this was a good episode, then please do leave a rating for the show on iTunes or wherever you get your podcasts. It helps others like you find the show, and I, for one, would really appreciate it. In any case, have a great week and speak to you soon.